What's going on, everybody? Liam O'Reilly, Vermont economic realtor. Hope you're doing well. Wanted to talk today about the other half of quantitative tightening that the Federal Reserve is doing. The first half being raising interest rates, the second half being reducing their balance sheet. So basically, what they're doing is they're reducing the size of their balance sheet, reducing the assets that they have, as an attempt to tighten the economy, to take money out of the system and bring inflation down. And how they're doing that, or a big portion of their balance sheet, are mortgage-backed securities. And I think what what they're doing in relation to those mortgage-backed securities has implications for the overall housing market and for the mortgage market, with interest rates and things along those lines. So if if you are familiar with the Great Financial Crisis, have seen the movie The Big Short, anything along those lines, you probably know what a mortgage-backed security is. Basically, it's a grouping of mortgages that are lumped together and then sold on the secondary market to investors. One of those investors over the past, you know, 15 years has been the Federal Reserve, who has been there to buy these mortgage-backed securities, essentially hold on to a bunch of mortgages, and allow, which has allowed more money to flow into the system, given banks more liquidity, and allowed interest rates to stay low on these mortgages for an extended period of time. Now, there's a few things to unpack there. So how do they bring more liquidity to the system by purchasing these mortgage-backed securities, and how will they take liquidity out by stopping by reducing their balance sheet, letting these mortgage-backed securities run off and not purchasing them? So basically, when what they're doing with these mortgage-backed securities, what they allow is, you get a mortgage for a home. The bank gives you that mortgage. They give you that money. That money's created, taken from, essentially. I mean, it's not exactly how this works, but it's easy to think about. If the bank has $500,000, they give you those $500,000, and they have a mortgage. You have the mortgage that you agreed to pay at a certain interest rate. You're going to pay the bank back over time. What the bank does is you have to abide by requirements set by Fannie Mae and Freddie Mac, and they will take that mortgage and sell it to Fannie Mae, Freddie Mac, who will lump it into a mortgage-backed security and sell that on the secondary market to somebody who is going to hold your mortgage and gain a return from it, if that makes sense. So what the bank is doing by selling that mortgage to on the secondary market is refilling their cup and giving themselves more money to lend to the next borrower, as opposed to lending you $400,000 to purchase a home and then holding that note, being out that $400,000 until they're slowly repaid over 30 years or so. They sell it on the secondary market, get that money back to where they can originate the next loan to the next buyer, and so on and so forth. So that allows the mortgage market and the housing market to flow relatively easily. Now, when the Federal Reserve purchases those mortgage-backed securities, they're purchasing it with money that isn't being used in the economy, isn't being taken out of the system, because the Federal Reserve isn't somebody who's active in the economy. They are not. The Federal Reserve as an entity isn't out there going out to dinner or spending their money on hotels and things along those lines. That's not the purpose of the Federal Reserve. So when they purchase these mortgage-backed securities, essentially what they're doing is they're the ones holding the mortgages, not the bank, which gives the bank more money to lend to you as the borrower, and creates, adds more money to the system that wasn't there, right? So the bank gives you a loan for $400,000 because they have their $400,000 in the bank. And I know it doesn't work like that, but it's just easy to think, easy to understand if you think about it this way. So they have their $400,000 in the bank from the depositors. They give it to you to get a mortgage on your loan. You're going to pay them interest over time. They are going to take that note, that mortgage, sell it on the secondary market. Once it gets bought, their $400,000 comes back to them, and they can give that to the next person. So when the Federal Reserve buys it, they're not taking money out of the system because that money was never in the system. When the Federal Reserve stops buying those mortgage backed securities, other investors, whether institutional or retail investors, are going to have to come in and purchase that mortgage backed security on the secondary market in order to keep the flow of the mortgage market moving. So instead of the Federal Reserve being there to purchase it, somebody who, instead of putting their money into the stock market, or if you're a retail investor, or somebody who would spend their money into the economy, or choose to invest it in other ways, is going to, there are buyers, there are investors out there who see the rates on these mortgages and are going to choose to purchase these mortgage-backed securities and invest in that asset class, which takes money out of other investments in other parts of the economy where that investor, those institutions, could spend it, if that makes sense. So that's how money gets taken out of the system when the Federal Reserve stops purchasing these mortgage-backed securities. Now, there are people out there who purchase these mortgage-backed securities. There are investors out there who do this. The interest rates that were kept so low over the past 15 years, in my opinion, part of the reason why they were able to be so low is because the Federal Reserve was the one purchasing these mortgages. So they didn't really care about the return on that they were getting when they were purchasing these loans. But because their job is to stimulate the economy. Their job is to make sure that the housing market is flowing well, and that inflation is sitting at 2%, as they've said many times. Their job is not to make a fantastic return on these mortgage-backed securities. But when they stop purchasing them, the investors, and the institutional investors, the retail investors, their incentive is not to keep the housing market flowing. Their incentive, your incentive, if you are going to be an investor into this asset class, is to get a reasonable return. Mortgages are a pretty, relatively speaking, safe asset, especially if it's a mortgage-backed security, which is a bundle of mortgages. So your risk is dispersed over multiple mortgage holders. So if one mortgage, goes, one home gets foreclosed on, or one mortgage gets paid off quicker, you have these other mortgages to continue to pay you and continue to give you that yield, that interest rate over time. But as an investor, if you have other options to invest in, you're not going to take, for example, a 2% or 2.7% mortgage rate, especially when you can purchase U.S. Treasuries for less than that. So what's going on right now and how this is affecting the mortgage market is, instead of the Federal Reserve being there to purchase mortgages at whatever rate, at whatever low rate they want the market to be at, they are pulling back. They're not purchasing these mortgage-backed securities anymore, which essentially leaves it up to the market and these institutional investors to decide if this yield, if the interest rate is worth the risk, worth the investment to them, if they're getting a good enough return on their mortgage-backed security, which is how the mortgage rate and the interest rate on your home is influenced by the bond market and the U.S. Treasury market, because those are similar asset classes that these investors are looking at to invest in, and they're comparing the bonds that they can invest in to the mortgage-backed securities that they can invest in. So bringing that all together here, I think that is a big reason why interest rates on home loans have gone down, even though the Federal Reserve hiked interest rates recently, because these institutional investors and retail investors that are coming in and purchasing these mortgage-backed securities. And once they, essentially once the interest rate, there's enough of these investors right now where, and there's not that many mortgage-backed securities being issued. That's another thing that I forgot to mention in this video until now. But take a look at this. Right over here, year-over-year statistics, issuance as of November down 52% year over year, which makes sense, right? Interest rates are a lot higher than they have been. People aren't refinancing as often. There's not inventory's tight. There's not as many home buyers, not as many home sellers. So issuance of these mortgage-backed securities has decreased, but there's still enough investors out there to purchase mortgage-backed securities at the around 6% return that they deem is okay. But if we see an increase in demand for mortgages and inventory goes up, supply and demand start to get to an equilibrium, and the amount of mortgage-backed securities being issued exceeds the demand of investors out there to purchase those mortgage-backed securities, then we're going to see interest rates on mortgages rise until the mortgage-backed security rate, the mortgage rate, is suitable for the investors to want to purchase in relation to the other asset classes that they are considering. So we're entering a time of a more free market mortgage rate market and secondary market than we've seen in the past when the Federal Reserve was purchasing those assets and keeping the rates low. So let me know what you guys think. I'm going to continue to work through these thoughts in the upcoming months, and it's going to be interesting to see what happens with this theory and how the housing market and how supply and demand in the housing market influence the mortgage rates and the people purchasing these mortgage-backed securities. Anyway, leave me a comment. All my contact information is listed below. If you're looking to purchase a home, either in Vermont or across the country, feel free to reach out. Leave a comment. Let me know what you think about this video, or feel free to reach out to me personally. And I will see you guys in the next video.